UK banks are sitting near multi-year highs. And the macro backdrop looks like it is actively working to pull them down. That tension is the starting point. Not a contradiction to resolve quickly, one that runs through every earnings call scheduled for the next 6 weeks. The UK private sector flatlined in March. Services PMI came in at 50.5, revised down from a preliminary 51.2. That is 11-month low territory. Business confidence has hit a record low. And yet gilt yields are climbing, because markets are now pricing in a rate hike from the Bank of England, rather than the cuts that were expected earlier this year. That combination, stagnant growth, rising rates, energy-driven inflation, has a name: stagflation. And it is the single environment that makes bank analysis genuinely difficult, because the two main levers of bank profitability pull in opposite directions at the same time. Higher rates expand net interest margins, that is the straightforward part. The part that gets less attention is what happens to the asset side of the balance sheet, when households are simultaneously squeezed by energy costs, elevated mortgage payments, and a labour market losing momentum. Credit quality and margin expansion stop moving together. That divergence is the core tension in UK banking right now. HSBC, Barclays and Lloyds each sit in different positions relative to that tension, and the market has already started pricing the divergence. HSBC has put up an 81% one-year return and trades near its 52-week high. Goldman Sachs initiated with a buy. Zacks upgraded to strong buy. The dividend was raised to $2.25 per quarter, up from 50 cents, a move that pushed the yield to roughly 10%. On the surface, this looks like a bank firing on all cylinders, but HSBC's payout ratio sits at 148%. That means the dividend is being paid out of more than earnings alone, a structure that is sustainable only if capital generation holds or asset sales continue. It is also flagged by some models as trading 40% below estimated fair value, which at a $310 billion market cap, implies either a significant valuation gap or a significant earnings risk embedded in that consensus. Barclays is down 10% year to date, despite being up 71% over the past year. Q1 results are due April 28. The bank has been expanding into the Middle East. A provisional Saudi Arabia license was granted in October. Higher rate expectations could lift net interest income. But if oil price inflation keeps squeezing UK consumers, the transactional fee income that Barclays depends on through its retail and cards businesses faces a direct headwind. The setup into April 28 is asymmetric. A 71% trailing return means the bar for a positive earnings surprise is high. Lloyds is the most directly UK exposed of the three. The share price has doubled from 40p lows over 2 years, now trading near 96p. The effective yield for investors who bought in early 2024 exceeds 10%. But analyst price targets span from 70p to 115p, a range that reflects genuine disagreement about where UK mortgage credit goes from here, not just modelling differences. The reversal point that much of the rate optimism narrative skips over is the mortgage channel. The Bank of England held rates near zero through most of the 2010s. When rates moved to 5.25% in 2022, UK mortgage borrowers faced resets at a scale not seen in a generation. Now, instead of the rate cuts that were priced in at the start of this year, markets are leaning toward further hikes, driven by the inflationary shock from the Middle East conflict. The Iran ceasefire agreed April 8 is only a 2-week pause. Energy markets have not fully repriced a durable resolution. The direct consequence? Homeowners are looking at an estimated £4,000 annual increase in mortgage costs from the conflict's inflation pass-through alone. That is not a peripheral data point. There are over 116 separate mortgage-related references in this week's UK financial press. The Iran conflict has been described in housing coverage as another nail in the coffin for house building, as mortgage rates continue to climb. For Lloyds specifically, this is the central underwriting risk. Lloyds is the UK's largest mortgage lender. When NIM expands because rates rise, the gain on new lending is partly offset by the arrears risk building in the existing book. That dynamic played out in 2008, and again in 2022. The question this cycle is whether the labour market holds long enough to prevent the arrears wave from materialising. UK business confidence at a record low does not support that assumption, but it does not confirm deterioration either. For Barclays, the mechanism runs through consumer credit rather than mortgages directly. Squeezed households reduce discretionary spending. That compresses card transaction volumes and fee income, the revenue lines that held up Barclays. investment case during the ZIRP era when NIM was suppressed. Two credible paths forward from here, and the evidence does not cleanly favor either one. The first path, the Iran ceasefire holds, energy prices stabilize, and the Bank of England pauses before hiking. In that scenario, the stagflation narrative loses its anchor. UK gilt yields pull back. Mortgage stress recedes faster than the current forward curve implies. HSBC's Asia and international wealth exposure, underscored by the promotion of Max Xu to lead international wealth in China, becomes the dominant earnings driver rather than the UK macro drag. Lloyds, 10% effective yield, held by investors from early 2024, looks durable. Barclays enters its April 28 result with a cleaner setup than the 10% year-to-date decline implies. In this path, the 40% discount to fair value flag on HSBC becomes the operative number. The second path, the ceasefire collapses within 2 weeks, oil prices re-escalate, and the Bank of England follows gilt markets into a hike cycle. Societe Generale has already flagged UK outlook deterioration under an energy shock scenario. JP Morgan's CEO has warned of significant interest rate shocks ahead. In this path, NIM expansion is real but brief, overtaken by rising provisions as mortgage arrears accelerate and consumer credit quality degrades. Lloyds, bear case target of 70p, roughly 27% below current levels, reflects this scenario. The windfall tax risk, which was floated for banks last year and not implemented, re-enters the political conversation. That the energy sector absorbed it in 2022 while banks did not, is not a permanent guarantee. The evidence leans slightly toward the first path on a 2 to 3 month horizon, conditional on the ceasefire holding and no further energy supply disruption. But the second path has more structural momentum behind it. Record low business confidence, a services sector at an 11-month growth floor, and a housing market already under cost pressure before any further rate action. One figure that does not fit neatly into either narrative deserves direct attention. HSBC's dividend payout ratio of 148%. A payout ratio above 100% means the dividend exceeds net income in the reporting period. This is not automatically a red flag. Banks can sustain it temporarily through capital releases, asset disposals, or strong operating cash flow that diverges from reported net income. HSBC has been restructuring, including its Swiss operations where Alfonso Gomez was just appointed CEO, and the proceeds of those moves can support distributions in the short term. But a 148% ratio at a 10% dividend yield, sustained into a potential rate hike and credit deterioration cycle, is a structural question that the strong buy ratings from Goldman Sachs and Zacks do not fully address. If earnings come under pressure from UK or Asian credit costs and the payout ratio is already above earnings, the dividend becomes the adjustment variable. That would reprice the yield argument that currently underpins much of the HSBC bull case. The Erste Group raising its FY 2026 EPS estimate from $8.30 to $8.40 suggests incremental optimism at the margin. But the FY 2026 consensus remains at $6.66, a gap of roughly $1.74 per share between consensus and Erste's revised figure. That spread reflects real disagreement, not noise. The one-line frame for this entire setup: UK banks have priced in the rate tailwind, but the credit headwind is still arriving. Whether the tailwind outlasts the headwind, that is the earnings question of the next 2 quarters.